Hi guys, this is Raymond and welcome to everything. It's been a long while since I posted a video, and today I'm motivated to start a series of videos to discuss AI, robots, ethics, and the dangers. Well, we've been talking about AI for some time. The whole world is sort of crazy about the usefulness and the power of AI. And in this series today, I'll be talking about AI and your money, AI and your investment. In today's world, a lot of people are investing in AI or investing in AI or tech stocks, hoping that it will bring them exponential returns. But there are some things that have not been talked about yet, and that is why I want to talk about it. First of all, the AI we are using today is called narrow AI. Narrow AI is an AI basically designed for specific purposes like coding, like answering questions, like general reasoning, and general content creation. For example, the Alexa you have in your home that is turning on and off your lights, your air condition, is a narrow AI. We are nowhere close, or we haven't developed what we call general AI. The general AI is what behaves like you and I, what is able to think, to be creative, to start conversations, to reason, to have awareness and consciousness. We do not have that. And it's a long way because these are machines. What we have to understand is that these are machines. They are behaving based on a pattern that has been put in them or programs. They even have their cutoff point. For example, if you can ask your chat GPT or your Grok or whichever you're using, when it was last updated, it will show you the date. And sometimes for some of them, it's so unfortunate that the dates are a little bit behind, and therefore it will tend to hallucinate, meaning that it will tend to tell you a lie when you ask it a question and there's no immediate answer or it doesn't know what to say. And so it will hallucinate and try and, you know, confidently produce some information that is not really correct. Now, in this part, this is part one, many people are investing in these AI stocks in most Western countries and hoping that it will produce exponential returns. Today in Ghana and many parts of African countries, we have tools or apps that allows us to invest in foreign markets and buy stocks in Europe, in America, and many other places. You see, in my personal opinion, is what I'm sharing with you because I understand investment and I do a little bit of it. And we are heading towards a bubble. What is a bubble? Let me throw a definition at you. A bubble is a situation in a market where the price of an asset rises far above its real or intrinsic value, driven mostly by fear, missing out, speculation, excitement, rather than the actual fundamentals. Now, somebody will say that the actual fundamentals behind AI is what we are seeing in the bull market of AI stocks and tech stocks. But the real deal is this: many people are afraid they may be missing out, and therefore they are spending a lot of money. For most of these AI founders, they are not making any money yet. And therefore, this bubble that we are all following, many people are following, is about to burst. How do I know that? The humans, as we are, oftentimes we have very short term memory. And that's why politicians play us a lot because they know that after 4 years, you're going to forget. And then they come up with the new story that you're going to make things better. And then you give them the nod and they don't do anything good. And it's happening in many places all over the world because we are people of short-term memory. Because the least excitement, we forget the dangers that we're exposed to or the bad times we have experienced, and then we decide to go with that same person because our memories are short-term. Now, we some of you here remember the dot-com bubble in 2000 to 2002, where internet companies and these tech companies started experiencing exponential growth in their share prices on various stock exchanges around the world, the Nasdaq, their counterparts in Asia, and so on. And there was this rush, this fear of missing out, this excitement and euphoria around these stocks. And many people started investing in them. The internet era, I remember those days. One of the tools you should know how to use it, how to do I think Google search. Otherwise, it was difficult to get a job. But you see, in these bubbles, the market fell 78%, minus 78%. In as much as the internet was good, in as much as it was a good thing to use and it was solving a lot of problems, and you could send emails, and a snail mail took a month to get to some parts of the world, whereas an email took just a minute, the bubble busted. The euphoria, the excitement that caused people to throw money at these stocks got busted, and people lost 78% of what they invested. This is a cycle, and it's happening, and it's going to happen again. Now, in the 1800s, around 1840 thereabout to the period of 1870, the railroad or the train system was put in place. It was an exciting time because it was going to make travel faster, safer. It was covering many parts of Europe and America, North America especially. And they were excited about having these trains running. So companies, people, investment organizations started investing in these stocks because it was going to help the population. It was going to help everybody. One of the interesting things to know is that the investment public or your asset manager will keep telling you to continue to invest in a particular direction. But your asset manager may not have his or her money there because for most part, they are aware of the cycles and they know the bubble is going to burst, and therefore they will not put their monies in there. And it happened in the period of 1840 to the 1870s. The market fell an average of about 60 to 70%. The market fell. The trains are here. They are good. They are helpful. We saw all those who were there around that time, saw all the goodness that the train system was going to bring to their lives. Yet it popped, it busted, people lost money. I've talked about the dot-com era. I also talk about the financial collapse, the S&P 500 between the period of 2007 to 2009, where the S&P 500 fell minus 57%. There was a day called the Black Monday. That was in the 1980s, where the Dow fell 22.6% in a day. In a day. Look, and I'm not giving you financial advice. I'm telling you what I do in terms of when I want to put my money anywhere. Because these things give people an idea that they are missing out. It is a good time. It's a wonderful period. And therefore, they need to invest all their monies quickly, else they will miss out of the profit. Anytime I'm investing money where I have a sense of losing or missing out, I tend to turn the other way. The African markets, especially the Ghana Stock Exchange, has proven to be a much more resilient and a much more profitable place to invest money. That is why I believe in the Ghanaian Stock Exchange a lot. Because the bubble of the AI or the AI bubble is about to burst. Maybe by the end of this year, it could be sooner, it could be a bit later. But this bubble is so close to breaking that people are going to come to a point where they are going to lose 100% of their capital, 70% of their capital. Personally, I will run away from any stock or any index that is in North America. I would prefer to put my funds in African shares because you see, emerging markets are now emerging. So the potential there is far and outperforms all emerging markets. So Having said that, in as much as good AI is, what we have is narrow AI. These are the dangers. And I thank you for listening, and I'll come your way again with a part 2 to talk about other aspects of the AI. If you have questions, you can send them to me, and have fun. Bye bye.